Hey folks, David Frost, my strategic forecast. You're here for another episode of Common Sense Market Analysis. Today is Friday, September 29, 2017. We're looking at a daily chart of the SPY or SPDR, which is the proxy for the S&P 500. And we pretty much predicted yesterday that since it's the end of the quarter, it would be unlikely for the market to do anything except go sideways or higher into the end of the week, the end of the month, and the end of the quarter, and that's precisely what happened. In fact, we did go higher. The SPY was up 88 cents today, or about 1/3%, finishing the day at 251.35. And basically, 251.23. And basically, what's interesting is I've been doing some work on the S&P, and I'm thinking to myself, well, what happens if we do go higher from here, right? This is a bullish chart. There's no two ways about it. We talked about this bullish pattern developing, and as long as we stayed above 248.91, and this remained a bullish pattern, which it did, then we're likely to go higher. We are breaking out of this bullish pattern. And so there's a couple of things working here, and I'm just going to talk a minute about market symmetry. So the question is, and this is part of the art form of technical analysis, there's no right or wrong answer. It's only right or wrong after the fact. All we can do is go based on what historically has worked, but the problem is that I can look at market symmetry from a couple of different points on this chart, and we won't see which one is right and which one is where the market may top out until after the fact. But here's what I'm talking about. So if you just take this gap higher and the gap window here that we've been talking about that would produce a sell signal for the market, right? Closing below this level would produce a sell signal for the market. However, where we are right now is pretty much a symmetrical move from where we started this gap window on this day here, okay? And we went higher, we consolidated, you take this low point and you go higher once again, and here we are. And that to me is market symmetry. So if you measure from here to here, okay, and then if you measure from here to here, that doesn't work. So we've already surpassed that. So then I have to take another point on the chart, and what I'm going to do is, and this is where it's going to get a little interesting, I'm going to take the low point here, okay, and I'm going to say, if the market went this far on this move, okay, and then we had this pullback here, is the market going to make a symmetrical move like the first one up from here? So this being move 1, and then are we going to have move 2? And I don't think I could draw a 2 with this thing. It's a Z. We'll use a Z. So if move 2 is equidistant to move 1, or symmetrical or a measured move, where does that put the market on the upside? And the reality is, and this is a little crazy, but the reality is it puts the SPDR up at 256.57. I don't know that that's going to happen. I would find it hard to believe that's going to happen without any kind of a pullback. But if we're going to complete a symmetrical move, where I would think it would start from would be this pivot low up to the recent highs where we began to consolidate. We consolidated, you take the pivot low out of the consolidation pattern, and you have another measured move higher, and that brings us to a number of $256.57. Now that number may seem a little out there for now, but we'll leave it on the chart, maximum of 256.57. Obviously, it could be 256, it could be 257, 256.50, anywhere in that zone. It doesn't have to be to the penny. That's just the mathematical number that I calculate based on the measured move or symmetrical move out of this breakout pattern. Now, we didn't necessarily consolidate for long enough to make this move right now, meaning within the next few days or into next week, anything like that. We would need to, pull back, consolidate again, continue higher. But if you just look at the measured move possibilities, that's where the market brings us. I don't know that that's going to happen. I don't necessarily think that's going to happen, but I have to look at the maximum upside of where we're going from here if we're going to continue up. Now we'll talk about the other side of the equation. Is there going to be any downside in this market? Well, the cycle still says that the market should be having a pullback, And generally speaking, September, or at least late September into October, is generally a volatile time for the market. That's the time, if there's going to be any kind of a correction in this market, more than we had already. And the correction I'm referring to is the one where I thought we were beginning the real correction, which was here on August 8th, and we only went down to here, and that was the end of it, and then the market took off again to the upside. So the cycles are really down through October, and then what you typically will get is somewhere in the month of November, you get some kind of a bottoming scenario, and then you get that end of the year rally into the holiday season. That's typically what happens almost each and every year. We'll see what happens this year, but if we can get through October without a correction, that would be quite the feat for the market. Now we're getting into October starting on Monday. This was the last day of the quarter, last day of the month in September, last trading day, and therefore we'll see what happens. Generally speaking, though, I wouldn't necessarily be looking for any kind of downside on Monday. Obviously, it could happen, but the first day of the month, first day of the quarter, you have a lot of money flow into the market, and therefore it's general that the market will kind of levitate on Monday coming into the first day of the quarter, first day of the month. So I wouldn't necessarily look for any downside on Monday, but it could happen. Anyway, if we're going to get downside, the same numbers apply. Our first area that we're going to be watching is the 248.91. That's an important level. The second level and the real level where the sell signal comes in and we could see some real downside activity in this market still remains 248.02, which is this gap window here. Any close below that level, and that will be a sell signal for the market. But mind you that the market, the farther it gets away from 248, the less likely we're going to get that sell signal. We may get a correction. It may be from a different number, and it may just come down to check back in at the 248.91. That's another possibility. Or the 248.02 level may hold. It all depends on how high we go and from where we start the next pullback, wherever that and whenever that may occur. Now we go over to the IWM, and we did close the month above our upsloping trend line in the IWM. Now it's not the first time we've done that. So you can see here that we've tested it a number of times, and it's questionable right here in the month of, when was this? This was the month of February. Whether or not we closed above this trend line or not, it depends on where you draw the trend line and how accurate it is. It may or may not have, but this one certainly, with conviction, closed above this trend line. I think it's important. It's interesting. We had what I will call exhaustion volume the other day on Wednesday in the IWM, but we do continue higher, and we'll see what happens leading into the month of October. It's an interesting scenario. The IWM is and remains my favorite leading indicator on the upside, and it was telling us that the market was going to levitate higher, and that is what we have seen over the last several days, and so therefore we have to take that seriously, and the IWM is leading the market on the upside. Now, obviously, we're overextended. We're, very, very short-term overbought in this and other indexes. But when you look at this, the IWM on the 18th of August makes a low just above 134. And today, we closed at 148.18. That's less than 6 weeks worth of trading. By my math, that's a little over a 10% move in just 6 weeks' time. That's pretty remarkable in any index whatsoever. That tells me that they has to pull back at some point in time. Markets just don't go straight up 10% in 6 weeks and keep going. It just doesn't work like that. I know it feels bullish right now. It is bullish right now. We have to respect where the index is. I'm just giving you the broad brush from the 30,000-foot view from experience. We are short-term overbought, and this market will pull back. It's just a matter of from what price. And that's why we don't try and pick tops. And that's another thing that I wanted to mention tonight and talk through is, a lot of people like to try and short the market and guess where the top is going to be, and they end up losing money the majority of the time doing that. It's very unlikely that the average Joe can pick a top and be right the majority of the time. It's just not possible. Historically, it doesn't work that way. Certainly, you can be right some of the time, but the reality is you don't have to wait. You don't have to try and pick the top. All we have to do is wait for a sign of a reversal, whether it comes in the IWM or it comes in the S&P 500. Either way, we just have to look for the sign of a reversal. We do have an exhaustion type move from Wednesday. The market has not reversed yet. We will put in a reversal in this market at some point in time, and we'll obviously discuss it when that happens, from what number that happens. Tonight, we're going to look at the VIX, and you know what I say, the lower the VIX goes, the more or the higher the probabilities are that we're going to get some kind of a rally in the VIX. We're down in the low nines, and you know, look, we had the 929 level, and that was an arbitrary level that I put on the chart. It could have been 9, 9.25, 950. I just threw a line in there one day, and here we are making a low today of, here, I'll move the chart over so you can see, making a low today of 936, finishing at 951. So that's an area where, as long as you give yourself enough time, historically speaking, the VIX is not likely to stay down at these levels for very long. We got down to what was the number here? A low of 884 on the VIX, and that was on the 26th of July. So maybe we go back down and retest that, but we won't stay there for very long. So this is an area where you can begin looking to collect the VIX long, whether you play it by call options on the VIX, you play any of the exchange traded products on the long side, the VIX long side. Eventually the VIX is going to pop back up, and it's going to pay you as long as you give it enough time. Even if the VIX continues lower for a shorter period of time, or a short period of time, I should say, it's still not going to stay down there for very long. And you know how fast the VIX moves when it reverses on the upside. You can see it each and every time. We make a low, we reverse. We make a low, and even here, make a low on the 26th of May, and by the 31st, we're making a high of 1130 from a low of 965. So the VIX will move fast on the upside, so you just have to go in light and give yourself enough time, and you'll get paid on the VIX if you're so inclined to trade this vehicle. The transports continue a relentless move on the upside. My favorite, or second favorite, I should say, leading indicator on the up and the downside. And the transports, along with the IWM, have had just a tremendous move. And markets just don't continue vertical. It's not quite vertical. But when you look at this, here, let me just compare. So here's a vertical line, all right? And here's where we are now, okay? That is unsustainable without a shadow of a doubt. Markets just don't move up like that. It's not possible. Certainly they can move up for another several days higher than this. Markets can move a lot farther on the up and the downside than most people believe they can. However, we will have a reversal. We will have a correction in all these markets. It's just a matter from what price. But this move, I can tell you, is short-term overbought, and it is unsustainable. Some traders will ask, is this a doji candle from today, or at least a pseudo doji candle? Yeah, it's certainly possible, but we're not going to read too much into this candle. We're just going to wait for the signal of a reversal. I'm not going to say today is a signal of a reversal. It's a potential signal of a trend change, but it's certainly not a reversal. We have to distinguish between what a trend change signal looks like, and it a lot of times looks like a doji candle, but this is not a reversal, right? A reversal is a high volume reversal. It's a high volume candle on the downside. That's the type of thing we're looking for to say that we're in the midst of a reversal or the beginning stages of a reversal. So we may have seen the signal of a trend change, but we certainly do not have a reversal today. Looking at the NQ or the NASDAQ 100, this is the futures contract. We are not confirming, meaning there's a divergence between what the S&P, the IWM, the transports are doing, and what the NQ is doing. So it's interesting. I just wanted to repoint that out. I know we've looked at this before. If you want to look at the Qs, some people might not have futures quotes. You can look at the Qs. It's the same chart for the most part. So this is not confirming the breakout to new highs. Again, you guys know this is not my favorite market indicator or leading indicator whatsoever, but I do look obviously at all the markets, and I do take note that the NASDAQ market, meaning the tech heavy sector, is not confirming the breakout that we're seeing in the other markets. So it's interesting, it's of note, it's a puzzle piece, I put it on the table. Looking over at the gold market, to me, gold really wants to come down to fill this gap. This gap is officially at 1262.90. Maybe it's 1262.60. In that neighborhood, we'll call it 1262 is really where the gold market wants to come down to, in my opinion. So there's your 1262. Above that is a 618 retrace, and that would be a retracement from this pivot low, okay, to this pivot high. And your 618 comes in above this, somewhere in this neighborhood. I'm just eyeballing it. Your 7.5 retrace comes in below the 200 period moving average right here. So this is a big zone in here, right? So you have a zone. This we'll call this a box. All right, well, we won't call it a box because it doesn't look like a box. But in this zone is where we're going to find some level of support for the gold market. Down really at a overshoot of 1240 to 1245, and 1262 is really the number I think they're shooting for. I think it's weak. We may find support at the 100-day moving average. That's right here. This is this purple upsloping trend line. But for me, I wouldn't get interested in the gold market until around 1260, 1262, in that neighborhood. You do have some support with the upsloping 200 period moving average coming in today at just under $1,256. So in this zone, you're going to have a lot of chart support in here. It's just a matter of exactly from what number. And so what we do is we wait for the market to come to us. Let it fall. Let it put in the signal of a reversal. Let it put in a high volume day, a doji candle. Then you have something to trade against. We can trade against a doji low. We can trade against a reversal low. That's how you trade these markets. You let the market fall and wait for it to give us the signal of a reversal. And that's where we're able to hop on the long side for a high probability, low risk trade. Silver, same thing. My target is around the 1640 area. The same thing we would be looking for if silver falls into that zone. We would be looking for the signal of a reversal. We would be looking for either a reversal and have something to trade against, or even a trend change signal like a doji, and we have something to trade against, which would be the low of that candle on a closing basis. And that's the same routine for gold and silver, looking at both those markets. Let them fall, let price come into us. Crude oil, we remain consolidating above the 200-day moving average. It's interesting. Now we've been up here for 5 days in this zone. We had one attempt at a breakout. It failed. And we continue to consolidate as long as we stay above the 200 period moving average, and then the line in the sand is the low of this green candle, comes in at 50.39. That's your line in the sand. And as long as we stay inside this green candle, preferably above the 200-day moving average, this is still in a bullish position, building energy, setting up for another move higher up into that 54, maybe even as high as 55 area. This chart is in an uptrend. Your moving averages are upsloping, and therefore it's the whole market is, or the crude oil market is still in an uptrend. And our first line in the sand is important, because if we break below this green candle low, then all bets are off, and we're most likely going back to do some kind of another retrace. But this is a bullish pattern, and typically these patterns will result in another move higher. Bond market, nothing much happened in the bond market today. It continues to be under pressure, downside pressure in the bond market below the 20, 50, 100-day moving average, above the 200-day moving average. Likely wants to come down and retest these lows in here in this zone. And if we do, then you're going to have a lot of support around the 200 period moving average and this double bottom area that we've talked about previously. So right in this zone here, there's going to be a lot of chart support. As we move away in time or forward in time, this 200-day moving average will continue to kind of slope upward a little bit into this double bottom area. So if the bond market did come back down into this zone, you're going to find chart support in here. No two ways about it. At least on the daily chart or from a daily chart perspective, and that'll give you chart support for at least a minimum of, 3 to 4 days time, most likely a week's worth of trading. And that's really at a bare minimum. The next market we'll look at is the dollar. And the dollar, we had a little bit more of a pullback today. We couldn't get through that area. We couldn't even get up to that area. That's the area I have my eye on. So I don't think that this market is bullish. I don't think we've bottomed. That's the stance I continue to take. I think we're looking at 88 to 87 cents on the dollar. And we'll see if the dollar holds or not. I just don't buy it. I think there's still downward pressure. I think the trend is still down in the dollar. And when you look at the weekly chart, now we've closed another week, so we'll look at the weekly chart and you can see here that, well, we closed pretty much on the weekly average. In fact, where does the weekly number come in? 92,891, and we close 92,885. So that's slightly below the 200-week moving average. So that's interesting. So what that's telling you is there's still downside pressure in this market. And you can see here, even though it wasn't a ton of consolidation, you can see this consolidation. The market rallied right back to that consolidation point from this low. And that's where we found resistance. This is a bearish wedge pattern for all intents and purposes. And likely we have another move down. That's the way I'm looking at the dollar. And with that, I'm going to give it a wrap tonight. It's everything I wanted to discuss. I'm David Frost, my strategic forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.